Okay, let's take a look at exercise 721, which involves transactions, but the focus is on liability transactions. So we've got the Ozark Sales Company for 2018, and we've got these 10 transactions. And then what we're going to do is use the horizontal statement model, and we're going to indicate how these transactions impact the various accounts. Now, I'm not going to work all of these, but I will work some of them. Let's take a look at number 3. 3 says we sold equipment for $203,500 cash, not including sales tax, and sales tax of 6% is collected when the merchandise is sold. The merchandise had a cost of $128,500. Okay, so we're in the business of selling equipment. We know that because we have sales and they indicate that it's merchandise. All right, so we've got to do some information to figure out how much cash did we actually collect. It's $203,500 plus the 6%. All right, so I've moved my little scratch pad calculator in front of you so you can see the calculations. If we take $203,500, the selling price for the equipment, times 6%, we come up with $12,210 as sales tax. So if we add the sales tax to the selling price, the $203,500, we're going to collect cash of $215,710. All right, so if I slide this down, now this is 3A, there's our $215,710. So we've got an increase of cash, $215,710. We have an increase in the sales tax liability of $12,210. Now, why does that increase? Because we collect the money from the customer, but we've established the liability, and the liability stands on our books until we submit those funds to the appropriate authorities. Okay, now, the next thing we have to think through is how much were revenues. Well, revenues came to the $203,500 of the selling price. Okay? Now, that obviously increases net income. The revenue portion is an increase to net income, which impacts retained earnings. I slid over a little bit so that you can see how you would show the impact on the statement of cash flows. Well, this is an operating activity, and it has a positive effect. Okay, we're not done with transaction 3 though, because we also have to show the fact that the inventory no longer exists on our books, right? We've had a sale, so legal title to the inventory now belongs to the customer. So inventory has to decrease by $128,500. And since we're following accrual accounting, we have to show the expense of $128,500. And of course, the account we would use is cost of goods sold. But notice that there's no impact on cash, right? We've already shelled out the money for the inventory when we purchased it previously, but when we record a sale, there's no cash impact for the inventory portion. The fact that we credit inventory, or not credit inventory, but decrease inventory and increase an expense, that impact doesn't impact cash. Okay? Now, the fact that an expense increases reduces net income. So we've had a positive effect from sales and then a negative effect from the cost of goods sold, which is an expense. And that has a $128,500 negative impact. This is the cost portion on retained earnings. Okay, now let's look at transaction 4 as well. 4 says we provided a 6-month warranty on the equipment sold. Based on industry estimates, the warranty claims would amount to 3% of sales. So if I bring my scratch pad over again, if we take the $203,500 of sales, that's what we had for transaction 3, and we take it times the 3%, which is the warranty estimate. So we're estimating of the $203,500, we're going to have warranty claims associated with those dollar sales equal to $6,105. Okay, so if we slide this out of the way now, we can see that what we have is an increase in our warranty liability of $6,105. Now, why is that an increase? Because we're following accrual accounting principles, or the accrual accounting system, and the accrual accounting system says we record revenues when they're earned and we have to match the expenses to them. So of the sales we had, we're estimating 6% are going to cause us warranty costs, or 3%. Comes out to $6,105, but it's 3%. Make sure I have the right percentage. Yep, right there. Okay, so we need to show warranty expense of $6,105. That increases the expenses. Obviously, expense decreases retained earnings, and we show the obligation. Now, who do we owe that money to? Our customers, the customers that related to the sales we had this year. Now, do we absolutely know for sure that's the dollar amount we owe? No, we don't. It's an estimate. But with accrual accounting, we are allowed to use estimates. In fact, we're encouraged to match expenses to the revenues, and when doing so requires an estimate, we do so. Okay? No impact on cash. So over on the statement of cash flows, we would say NA, just like we would say NA for the cost of goods sold portion of the sale that occurred on transaction 3. Okay, now just want to point out that on transaction 6, which I'm not going to work, but I want to point out it says on September 1st, 2018, the company borrowed $20,000 from a local bank at 6% interest. Okay, so on that transaction, you have to think through what increased and what decreased, if anything decreased or if anything increased. Borrowing money from the bank, that means we're going to collect cash, so we know we're going to have an impact there. We borrowed the money, that means we have an increase in some kind of liability, some kind of obligation to pay it back. Okay, but I want you to work through that one here. Now, on transaction 10, we record the accrued interest on the notes issued. Now remember, again, we're matching expenses to revenues. Now in this case, the interest isn't directly related to revenues of the period, but we use the indirect relationship and assume that interest that we incurred related to the sales we had incurred in that period. So we have to accrue the interest in the proper period. Now what that means is you need to record an expense for the interest, and you need to show the obligation that you have to pay that. Now, we're not going to pay it during 2018 because it's going to be paid in 2019. Okay, now I put this little box right here, right above where you see my mouse slightly moving, just to show you the calculation. Remember, you take the principal times the interest times however many months apply for the amount of expense you need to record. So, they had a September note, so we need to accrue the interest by the end of the year. So we've got September, October, November, and December. That's the 4 months. Okay, so principal times the interest times the portion of the year is how you determine how much interest was actually accrued during that period. Okay, I hope you find this helpful.